Hi, Assalamualaikum. My name is Rona Jaizati and my number is 298672 and I will explain the question one by one. So the first question is about the differences of a currency appreciation and a depreciation. Currency appreciation occurs when the value of a country's currency increases relative to another currency. In other words, we can buy more of a foreign currency with the same amount of our own currency. On the other hand, currency depreciation happens when the value of a country's currency decreases relative to another currency. This means that it takes more of our currency to buy the same amount of foreign currency. Let's use the Malaysia Ringgit RM and the Australian Dollar AUD as an example. Suppose the exchange rate is from 3 ringgit 20 cents per 1 Australian dollar to 3 ringgit per 1 Australian dollar. This means the ringgit has appreciated. Why? Because Malaysians now need fewer ringgit to buy 1 Australian dollar. It shows that the ringgit has become stronger. For Malaysians, this is beneficial when importing goods from Australia or traveling there, as they get more value for their money. Now, let's look at the opposite. If the exchange rate moves from 3 ringgit per 1 Australian dollar to 3 ringgit 30 cents per 1 Australian dollar, the ringgit has depreciated. This means Malaysians now need more ringgit to buy the same 1 Australian dollar, indicating that the ringgit has weakened. As a result, imports from Australia become more expensive and traveling abroad might cost more for Malaysians. In summary, appreciation means a stronger currency. It means we pay less for foreign money. The other hand, depreciation means a weaker currency. It means we pay more for foreign money. These changes are important because they will affect international trade, tourism, and the next question is about what is the fundamentalistic in the economic insights provided by nominal exchange rate compared to a real exchange rate. So, the nominal exchange rate refers to the actual rate at which one currency is exchanged for another in the market without considering inflation. For example, if the current exchange rate is 4 ringgit 50 cents per 1 US dollar, that is the nominal rate. The second one is the real exchange rates. Adjust the nominal rate by consider the differences in price levels or inflation rates between two countries. It reflects a true purchasing power of one currency relative to another and is more useful in comparing international competitiveness. The formula for real exchange rate is nominal exchange rates times to foreign price level divided by domestic price level. And for example, if the price of iPhone in Malaysia will be 5,000 ringgit, and so the iPhone in the US dollar is 1,500 US dollar. Nominal exchange rate is 1 US dollar equal to 4 ringgit 50 cents. We can convert the price of US dollar to RM ringgit Malaysia, which is 1,500 times 4 ringgit 50, and we got 6,750 ringgit. Since 6,750 ringgit is more than 5,000 ringgit in Malaysia, it means that the price of iPhone in Malaysia is more cheaper than the price of iPhone in the United States. The next question is about the difference between the spot market and forward market. The spot market is where foreign exchange transactions are carried out immediately. The currency rate used is called the spot rate, and the currency is exchanged immediately, usually used to immediate payments for goods or service and also urgent international transactions. In contrast, the forward markets involve a contract to exchange currencies at a fixed rate on a future date. This is known as the forward rate. Businesses use this market to hedge against exchange rate risk, especially when they expect future payments or receipts in foreign currency. For example, in Malaysian manufacturing company, a Malaysian company plans to re-import essential machines from the US in months. The total cost about $150,000. They lock in a forward contract today to buy $150,000 at a fixed rate in 3 months. So the forward rate is about $1 equal to 4 ringgit 50 cent. And the amount that the company need to pay in 3 months is about 675,000 of future rate cash. How we get the 675,000? So we take the 150,000 and times to 4 ringgit 50,000 and we got 675,000. So why we choose forward market? If the company waits and use the spot market in 3 months, the rate could rise to 4 ringgit 18 cent per US dollar. So the increasing will cost the company to RM 720,000. By using the forward market, the company can avoid uncertainty and locks in a known cost, which helps with budgeting and also financial planning. The second one is exchange rate loss. If the RM depreciates, the company can avoid to pay more in the future. For the next question, given the data below, we need to determine the RER between RM and Japanese yen in both the initial and also final period. So I will discuss how the result can reflect Malaysia's trade competitiveness with Japan. So the nominal exchange rates RM over 100 Japanese yen. For initial period is 3 ringgit 80 cent and for the final period is 3 ringgit 60 cent. And for Malaysia CPI, Customer Price Index is 105 for initial period and 110 for final period. The second one, which is Japan CPI, 100 for initial period and 102 for final period. So I will conclude the formula, which is RER equal to nominal exchange rates times foreign CPI divided by domestic CPI. So we can conclude here that Malaysian CPI can be domestic CPI and Japan CPI is a foreign CPI. Initial period RER equal to 3 ringgit 80 cent times 100 over 105. We can get 3 ringgit 62 for initial period RER. And the final period RER, we can get 3 ringgit 60 cent times to 102 over 110. And the answer here is 3 ringgit and 34 cent. So the RER decline. So the RER decreased from 3 ringgit 62 cent to 3 ringgit 34 cents, which is indicate a redepreciation of the ringgit against the yen. This means that Malaysian goods become cheaper relative to Japanese goods. Thus, the increases Malaysia's trade competitiveness. Malaysian exporters may benefit from this change as their products become more attractive in the Japanese market. In other words, this means that Malaysian goods is more affordable for Japanese people, even though RM value seems relatively strong. The next question is, I will evaluate an investment decision involving a Malaysian investor who can invest in either the UK or Malaysia using the interest rates and exchange rate expectations to calculate and compare returns. The given data, which is investment amount equal to 150,000 ringgit, Malaysia interest rate 2.0%, UK interest rate 3.2%, current exchange rate, which is 5 ringgit 50 cent over GBP, expected future exchange rates which is 5 ringgit 30 cent over. So the first option, which is invest to Malaysia, we can calculate that the return money we got from investing in Malaysia is about 153,000 ringgit. How we get that? We can get by 150,000 ringgit times 1 plus 0.02, and we got 153,000. The option number 2, which is invest in the UK, we need to convert the money to GBP first, according to today's exchange rates, which is 150,000 ringgit divided by 5 ringgit 50 cent, and we got 27,272 ringgit 73 cents GBP. And we can apply the value to UK interest rate by doing 27,272 ringgit 73 cents times with 1.032, and we get 28,145 ringgit and 46 cents. And after the total, we need to convert back to RM to expect the future rate, which is 28,145 ringgit 45 cents times with 5 ringgit 30 cents. We get 149,000 and 170 ringgit 94 cents. So here we can see that the return for investing in Malaysia, we can get 153,000 ringgit, and return from investing in the UK, we can get 149 and 170 ringgit 94 cents. Despite the higher UK and interest rates, the expected depreciation of the pound results in a lower final value when converted back to ringgit. In this scenario, it is better to invest in Malaysia as the exchange rates movement offsets the benefit of higher interest abroad. So, I think the better choice is to invest in Malaysia. The next question is question 7. The question asks me to clarify the differences between a long and short forward position in the context of foreign exchange contracts. I will also provide an example involving the Malaysian ringgit, RM, and the British pound, GBP. The first one is long forward position. This means a long forward position refers to an agreement to buy a foreign currency at a specific future date and rate. The holds anticipates that the foreign currency will appreciate in the future. For example, a Malaysian company expects to pay a British supplier in GBP 3 months from now. To avoid the risk of the British pound depreciations against the Malaysian ringgit, the company enters into long forward position by agreeing to buy GBP at a rate of 4 ringgit 50 cents per over GBP. If the actual spot rate in 3 months increases to 5 ringgit 60 over GBP, the company benefits by paying less than the market rate. The other one, which is short forward position, it means that it refers to an agreement to sell a foreign currency at a specific future date and rate. The holder also anticipates that the foreign currency will depreciate in the future. So, for example, a Malaysian exporter expects to receive payment in GBP 3 months from now, concerned that the British pound may weaken. The company enters into a short forward position, agreeing to sell GBP at 4 ringgit 50 or 50 cents over GBP. The exporter benefits by securing a more favorable rate in advance. Summary: a long forward position is about agreement to buy foreign currency in the future. The other hand, a short forward position is about the agreement to sell foreign currency in the future. Both strategies are used to manage exchange rate risk depending on whether the company expects to pay or receive foreign currency. The next question is question number 8. I need to explain how to calculate the annualized forward premium or discount for the Malaysian ringgit against the Australian dollars, and also determine whether the RM is trading at a premium or a discount. So the given information is spot rate equal to 3 ringgit per 1 AU dollar. And the next one is 9-month forward rate, which is 3 ringgit 5 cent per 1 Australian dollar. The formula to determine the premium or discount is forward premium or discount in percent equal to forward rate minus spot rate divided by spot rate, and the total can need to times with 12 over number of months and times with 100. So we know here that the number of months is 9. The next step is we need to insert the value, which is 3 ringgit 5 cents. We need to minus with 3 ringgit and divide by 3 ringgit. Here we can get 0.0167, and we need to time with 12 over 9, which is 1.333, and times 200, and here we can get 2.22%. Since the forward rate, which is 3 ringgit 5 cents, is higher than the spot rate, which is 3 ringgit, and the premium is positive, it also indicates that the Malaysian ringgit is trading at a forward discount against the Australian dollar. This means it will take more ringgit to buy 1 Australian dollars in the future, reflecting a depreciation expectation of the RM. Summary, the RM is trading at an annualized forward discount of 2.22% against the Australian dollar, indicating that the ringgit is expected to weaken over the next 9 months relative to the Australian dollar. The next question is, I need to explain the use of a forward contract for a Malaysia exporter who is expecting to receive payment in euros, and how this can affect the ringgit proceeds compared to using the virtual spot rate. The given details is the exporter is to receive is about 100,000 euros in 6 months. And the forward rate is 5 ringgit 8 cents per euro. The expected future spot rate is 5 ringgit 20 cents per euro. So the option 1 is using forward contract. If the exporter locks in the forward rate, the RM will proceed. The RM proceeds will be 100,000 euro times with 5 ringgit 8 cents. We equal to 508,000 ringgit. If we use the future spot rate, if the exporter waits and uses the expected spot rate, we can get 100,000 euro times with 5 ringgit 20 cents, and we will get 520,000 ringgit. By comparing the two options, the forward contract we get 508,000 ringgit, and the spot rate we get 520,000 ringgit. The difference between the two contracts, we will get 12,000 ringgit. So by looking in the forward contract, the exporter will receive 12,000 ringgit less than if they had waited to convert at the future spot rate. In summary, from this case, the forward contract was not beneficial financially, as the exporter could have received more by waiting for the expected higher spot rate. However, many exporters will still choose forward contract to avoid uncertainty, even if it means slightly lower returns, because the actual future spot is not guaranteed. The next question, I will clearly explain the concept of absolute purchasing power parity (APPP) and also the relative purchasing power parity (RPPP), the two fundamental theory in international economy. I also highlight the main differences between them. The absolute purchasing power parity states that the exchange rate between two currencies should be equal the ratio of the price levels in the two countries. The formula is exchange rates equal to P foreign over P domestic, which is E equal to exchange rates, P foreign equal to price level of the foreign country, P domestic supposed to be price level for domestic country. If APPP holds, it means there should be no arbitrage opportunity and the exchange rates will adjust to equalize prices globally. The other one is relative purchasing power parity. Relative PPP, on the other hand, focuses on changes in price levels over time rather than absolute levels. It states that the rate of change in the exchange rate between two countries over time is equal to the difference in inflation rates between those countries. So the formula is E in bracket S1 minus 2 SO over SO equals to pi foreign minus 2 pi domestic. It shows that S1 and SO equal to initial and future exchange rates. Pi foreign supposed to be inflation rate for foreign country and pi domestic supposed to be inflation rate for domestic country. So if inflation is higher in one country, its currency is if inflation is higher in one country, its currency is expected to depreciate relative to the other. So in summary, APPP deals with absolute price comparisons, while RPPP addresses price movement over time. Both are useful for understanding how exchange rates should behave in response to inflation, but RPPP is generally more applicable in real-world economic analysis. The next one is I will explain the application of absolute purchasing power parity or APPP by comparing the price of a laptop in Malaysia and United States. I also will determine whether APPP holds based on the exchange rates. So the given data is that the price in Malaysia is 4,500 ringgit and the laptop price in the USD is about 1,000 US dollar and the market exchange rate is 4 ringgit 60 cent over USD. So we need to calculate the implied exchange rates under APPP. The formula is price in Malaysia over price in US equal to 4,500 divided to 1,000 and we got 4 ringgit 50 cents US. The next step, we need to compare with actual market exchange rate. So the APPP equal to 4 ringgit 50 cents over US dollar, but the actual market rate is 4 ringgit 60 cents over US dollar. Higher than the APPP rate, 4 ringgit 50 cents. This suggests that the ringgit is undervalued relative to the US dollar based on this product. This implies that the laptop is slightly more expensive in Malaysia than it would be if APPP held perfectly. In this case, absolute purchasing power parity does not hold exactly. The deviation is small. It may reflect factors such as import taxes, transportation costs, and also market inefficiencies. RPPP also is a theoretical concept. In real-world data often show slightly deviations due to suspicion. Question number 70. I need to analyze based on absolute purchasing power parity (APPP) and demonstrate whether there is an arbitrage opportunity in the international market using the example of a book price differently in the UK and the US. So the given data is price of the book in the UK is 14 pounds. Price of the book in the US is $60. The current exchange rate is £1 equal to $1.50, $1.4. The first step, we need to calculate the theoretical no arbitrage exchange rate under APPP. According to APPP, the exchange rate should reflect the price ratio of the same good in both countries. So we need to divide US price with UK price equal to 60 over 40, and we will get $1.5 over pound. So the implied exchange rate is one pound equal to $1.50, $1.5. Step number 2, we need to compare with the implied exchange rate with the actual market exchange rate, which is the implied APPP rate. We got $1.5 and the actual market rate is $1.4. Since the actual exchange rate, which is 1.4, is lower than the APPP rate 1.5, so the British pound is undervalued compared to the US dollar. This will create a potential arbitrage opportunity, so that a trader could buy the book in the UK for £40, convert to $50 to get £40, and then she will resell the book in the US for $60. So then he will get the profit with $60 and minus to $56, and he will get $4 in profit. So in conclusion, because of the current market exchange rate differs from the theoretical APPP rate, arbitrage is possible. In this case, an arbitrager could profit by purchasing the book in the UK and selling it in the US. The next question, which is question number 20, I will analyze whether an arbitrage opportunity exists using the theory of absolute purchasing power parity by comparing the price of a jacket in Switzerland and the United States. So the given data is price of the jacket in Switzerland is CHF 100 and price of the jacket in the United States is USD 90 USD. And the current exchange rate is CHF1 equal to 85 USD, 0.85 USD. So the first step is we need to calculate the theoretical exchange rate using the APPP. According to APPP implied exchange rates, the formula implied exchange rate is for US price divided by Switzerland price, and we got 90 over 100 and we got 0.90. So the theoretical exchange rate is CHF1 equal to USD 0.9. The second step is we need to compare the implied exchange rates to actual exchange rate. So here, implied exchange rates, we get CHF1 equal to USD 0.90. So the actual exchange rate, which is CHF1 equal to USD 0.85. Since the actual exchange rate 0.85 is lower than the APPP rate 0.90, the Switzerland francs is undervalued relative to the US dollar. This creates an arbitrage opportunity. So a trader could buy the jacket in the Switzerland for CHF 100 and he will convert to USD 85 into CHF 100 at 0.85 rate. So then he can resell the jacket in the US for 90 USD. From that, he can get the profit by USD 90 USD minus with 85 USD, and he will get 5 USD as a profit. Because of the actual exchange rate differs from the rate suggested by APPP and arbitrage opportunity exists, the exchange rate would need to rise to USD 0.90 over CHF to eliminate the profit incentive and restore parity. Question number 22 need to be explained on how the RM over Japanese yen exchange rate is determined by using the concepts of demand and supply in the foreign exchange market. So the fundamental concept is about in a floating exchange rate system, the value of a currency is determined by the interaction of demand and supply in the foreign exchange market. So the demand for Japanese yen is a supply for RM. The demand for Japanese yen will increase when Malaysians import the goods and services from Japan. It means when Malaysian people buy goods and services from Japan, it can increase the demand of Japanese yen. The next one is when Malaysian people travel to Japan for tourism or education. And the last one is when Malaysian people invest in Japanese stock, bonds or businesses. In all these cases, Malaysia exchange ringgit Malaysia to Japanese yen, increasing the demand for Japanese yen and supplying RM in the forex market. It means that when from this case, Malaysian people need to use Japanese yen more than ringgit Malaysia, so they will demand for Japanese yen, and this makes the ringgit Malaysia increases, make the supply arise. The second one is when the supply of Japanese yen increase and the demand for RM. The supply of Japanese yen will increase when Japanese individuals or firms import the goods and services from Malaysia, travel to Malaysia, or in education, invest in Malaysia's assets. In these cases, Japanese citizens exchange Japanese yen for RM, increasing the supply of Japanese yen and demand for RM. This causes the RM to appreciate and the Japanese yen to depreciate. The next question, which is 24, I will explain how to apply the uncovered interest parity theory to determine the expect future spot. To expect the future spot exchange rate between the Malaysian ringgit and the British pound GBP. The given data is Malaysia's interest rate, which is 2.5%, UK's interest rate, which is 4.5%, and also the current spot exchange rates, which is 5 ringgit 30 cents over GBP. So the step one is we need to discover the UIP formula is as follows. ET plus 1 equal to ST times 1 plus I foreign over 1 plus I domestic, where ET plus 1 expect to be a future spot exchange rate, ST, which is ST is the current spot exchange rate, I foreign is a UK interest rate, whether 4.5% or 0.045. How I domestic is Malaysian interest rate, which is 2.5% or 0.025. The next step is we need to plug in the values, which is ET plus 1 equal to 5.30 times with 1 plus 0.045 divided by 1 plus 0.025, and we got 5 ringgit 40 cents over GBP. Based on UIP, the expected future spot exchange rate after 1 year is approximately 5 ringgit 40 cents per GBP. This means that the ringgit is expected to depreciate slightly in the British pound due to Malaysia's lower interest rate compared to the UK. The last question, which is question number 27, I will explain on how to derive the real interest parity condition by integrating 3 key economic theories, which is the first one is the Fisher equation, the second one is the relative purchasing power parity, and the last one is the uncovered interest parity. So the third one is the Fisher equation relates to nominal interest rates to real interest rates and inflation. So the formula is I equal to R plus pi, where the I is nominal interest rate, R is the real interest rate, and the pi is expected inflation rate. And this will apply to both countries. I domestic equal to R domestic plus pi domestic. And also on the other hand is I foreign equal to R foreign and plus pi foreign. Relative purchasing power parity states that the percentage change in the exchange rate is approximately equal to the inflation differential between two countries, which is ET plus 1 minus ET over ET equal to pi foreign minus 2 pi domestic. The last theoretical theory is uncovered interest parity. It suggests that the expected percentage change in the exchange rates is equal to the interest rate differential, which means the formula is ET plus 1 minus 2S ET plus 1 minus 2ST over ST equal to I foreign minus 2I domestic. So we need to combine UIP and RPPP. Since both UIP and RPPP equate to the expected change in the exchange rate, so the formula will be I foreign minus I domestic equal to pi foreign minus pi domestic. The next one is we need to apply Fisher equation by substitute the IM and IF. So the formula will be in bracket RM R domestic plus pi domestic minus 2 in bracket R foreign plus pi foreign and equal to pi domestic minus 2 pi foreign. So we need to simplify the equation and we get R domestic minus 2 R foreign and equal to 0. The next one is the real interest parity is R domestic equal to R foreign. The real interest parity condition holds when real interest rates are equal across countries. R foreign equal to R domestic. This will implies that when capital is really more by an arbitrage axis, real returns on investment in different countries will be equal, regardless of currency movement or inflation differences. That's all from my presentation. Thank you.